Okay, so we're going to get straight right into it. I'm sure everybody can see my screen, right? So, like they say it in the popular parlance, in Gen Z parlance, this is the cocoa of the matter, right? For people that have been waiting for, okay, when is God of Indices going to share his strategy? All these things you are teaching us, you're just share your strategy. Let's just get it and be done with it, right? This is it. Then for people that have been following the lessons diligently, that beginners, and you just really want to know what works, right? You see that everything I'm teaching, from everything I've taught from the first class down to this point, you see it aligns, right? So this is it. I call it the God of Indices strategy, right? Because you it's a precise way I look at the market. You hardly find anybody looking at the market the same way. And like they say, no two traders look at the market the same way, even when they were taught by the same mentor or anything. You always find a tweak based on your own chart time with what you can work with, right? I remember I told us in our previous class that everything in my strategy has two primary things, which is time and price. Time and price, right? So everything we have learned, most of up to this point, we have looked at what price. I've looked at technical analysis, how to read price and everything. So in the strategy, you see, I don't want to go see. Understanding time is it's a long class on its own. It will take me like 3 sessions of the class to explain to you the time theory as relates to trading, right? So, but I brought out what you just need. You don't need to know everything about, or some people call it the quarterly theory or time theory, whatever you call it. You don't need to know the full detail about the quarterly theory. I just brought out what works, what you can incorporate, what I've incorporated in my trading strategy that works for me. So if you do the same, you just hit the nail straight on the head and to get working for you, right? So I told us that basically I talked about our institutional reference point, and I say I look at, there are two things I consider, right? Which is what I call my entry model, the God of Indices strategy. The entry model, I look at the breaker blocks and the inversion fair value gap, right? So I can add them, I can add to this. So inversion stroke. Sometimes I do FEG, right? So, but I can also say I look at breaker blocks and FEG, because inversion FEG is just a variant of the FVG, right? So remember in our previous classes, we looked at what a breaker block is. What a breaker block is, right? So we said that a breaker block will be, simply put, so that you don't start cracking your head. A breaker block is a order block that has been violated in whatever direction, right? So for this case, I'm showing you now, this is the bullish case, right? This is the bullish scenario, right? So there was a bearish order block here. Remember, you have to remember your class, like the last up close candle that took out a short-term level, right? So this also serves as the liquidity. That's what makes it a breaker. It takes out liquidity to the downside. Then that other block that engineered the run on liquidity, that same other block that engineered, when it's violated, when it's traded through, and they are healthy candle, there's an impulse to the upside, that other block now becomes a breaker block. Simple, right? So, and the same thing applies for a bearish scenario, right? The same thing applies, right? So this is the liquidity, right? Liquidity taken out, and sorry, I was explaining. Sorry, my bad. So this is liquidity taken out, right? Liquidity taken out, and there's an order block that engineered that run on liquidity is usually here, right? So when that order block is traded through, that becomes a breaker block, right? So I view this. Now, the next thing we are looking at is the fair value gap, right? Fair value gap, the same way I explained fair value gap in the last class, right, is a 3 candle price formation where you have candle 1, candle 2. Don't worry, let's just do it this way. This candle, I hope you understand. I don't want to start drawing the full candles, right? So you have something like this. So this is candle 1, right? This is candle 1. This is candle 1. This is candle 2, and this is candle 3. So the gap between the gap between the low for bullish scenario between the low of candle 3 and the high of candle 1, that is your fair value gap. Now, what is the inverted fair value gap? When price trades through, right? So this is for bullish scenario, right? When price trades through it and price finds resistance there, that becomes an inversion fair value gap. Now the reverse is the case for the bearish scenario. So imagine this was also a bearish. Let me delete this and show you. I'm just going through this annotation before we go into the chart. So imagine this was a bearish fair value gap, right? So bear value gap, this will be candle 1, candle 2, candle 3, right? The gap between candle 3 and candle 1, right? So we're expecting the bearish fair value gaps to respect price like this, but it doesn't, right? Okay, sorry. The first thing I explained was it I deleted. Okay. You are expecting to respect for the bearish fair value gap, but it doesn't respect. Instead, it goes and it violates that fair value gap. It comes and it finds support, and price keeps going up. So that is inversion fair value gap. When we go into the chart, we'll look at example and it will be a lot clearer, right? So basically, my trading way, the way I look at price, the way I look at the charts is based on these two institutional reference points, the breaker block and the inversion block, right? But for the higher time frame buyers, what we call our draw on liquidity, right? I didn't tell, so I'm teaching you now. So you didn't need to take a whole class on draw on liquidity. Draw on liquidity is just telling you where price is going to go to. It's just telling you where is price more likely to go to from where price is currently, or it's also called our daily bias. So I'm teaching you based off on a day trader that I am, but you can still put this concept on swing trading, short-term trading, whatever style of trading you decide to incorporate. But if you just decide to just delete everything you think you know and just embrace everything and trade it exactly the way I'm trading it, you get faster results like that. But if you want to modify it to suit your style of trading, maybe you want to use it for swing trading, then you have to spend more time to tweak it to make sure it suits your style, right? Are you guys with me? Let me be sure that my network is still on and you guys are hearing me.
Yes, sir.
Okay. So basically, this is very, 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 very powerful. Draw on liquidity and daily bias. This determines the direction to which you are going to take a trade. Now, daily bias will tell you that, okay, where the daily candle, where is it going to close? Is it going to be an up close candle or is it going to be a down close candle? That's daily bias. Is the candle going to close bullish or is going to close bearish for the day? That's daily bias. But draw on liquidity just tells you for that particular time you are trading, where is the draw? Where likely is price going to reach for? Which place, which liquidity is price going to reach for? Is it external liquidity or internal range liquidity, or is it a particular higher time frame institutional reference point at premium, or is it going to reach for a particular higher time frame institutional reference point at in your discount? Remember our class on PDRA, right? So that's basically drawn liquidity, and it's very, very important. Now I'm going to start by showing you these are the rules. I call it entry confluence, but I can as well call them the rules, entry rules. So let me call it rules. So I don't use grammar. Entry rules for the strategy. So this thing, you have to marry these 5 rules. It has to align these 5 rules. So I'm going to go to the chart right now. And what I'm going to do right now is, because I want to teach you in process, we're back testing, like this is the process of back testing too. I want to teach you, we're on the daily chart, right? So I want to teach you while we see what price did today, right? So let's get into the chart. Are there any questions from my explanations on the annotations? Any questions before we go into charts? Hello guys, any question?
No, no question, no question.
Okay. What's happening? My network is becoming slow. My bar replay tool is not okay. Yeah, it's working now. So let's see if it cuts. Okay. Okay. Today is Tuesday, right? So let's go on what first of all, what's the first rule? Order flow, right? You want to look at order flow, what's happening, and where is price. Order flow simply means that the direction to which they call it institutional or institutional order flow, the direction to which the big players, because we're on the daily time frame, the way the candles are closing will tell us the direction to which the institutions want to take price, right? So first of all, we are looking at order flow, right? So if you look at, let's magnify this and let's see. If you look at the candle here, right, we will notice that we came to, if we look to the right, we'll notice that based on our market structure, right, you see that this was an impulse that took out a high, all right? So I always want to start by that. Now, what does it tell? It tells that market structure is looking bullish. However, you see this impulse, the bearish impulse, right? 1 bearish candle, 2, 3, 4, 5 that closed down. This was a bearish impulse, right? So it tells us that currently to our right, where price is heading bearish, like candle close, they are closing below. But you see, by when we reach this zone, which is an order block, remember everything I'm teaching you, that's why I'm saying this try. So you have to put everything into plan. So I always like to mark the order block from the week when I'm marking from analysis, right? Why do I want to mark that? Because I want to see the mean threshold, right? The mean threshold, we call it mean threshold. Teaching multiple things now, so can't get mean threshold. Mean threshold is the middle point of an order block, the midpoint. This is the midpoint of an order block, right? So you want to see the reaction of price when it comes to that midpoint, right? I mean, personally, I don't trade any higher time frame institutional reference point. I don't trade an FVG on a higher time frame if the price has not come into the midpoint for my day trading. So as we go further, you realize what I consider as higher time frame for my strategy, right? So if you look at here, when price came to this place, you mark out this point. This is an order block. This is where the impulse started. This is the order block that engineered this break of market structure to the upside. Is what engineered the taking out of the previous high to make us know that we are in bullish direction, right? Can you guys hear me? Is the network clear? I'm feeling like the
Loud
network.
and clear.
Okay, loud and clear. Okay, that's good. So now that is what engineered this order block is what engineered this break of structure. So looking at it from these points, I know what's the first. I map in my mind. I'm building a story. Remember from our last class, I'm building a story. I know that okay, on the higher time frame, we are looking to be bullish, right? But I don't want to be so much concerned about what happened to the left side. I want to be concerned about what happened to the right side, which is the current leg of price, right? What price is doing currently, right? So if we magnify this and we look at what price is doing currently, we'll see that price was closing below each previous candle, right? Price was closing. You see this bearish candle. Let's look from the previous day. It closed what? Below this one, close below this one. This next bearish one, close below this other one, right? And I always want to consider closures based on week, right? Closure has to be underneath the week, right? But you see this one closed, but it didn't close directly the week. That tells us that the algorithm is setting to react off this other block. Seeing also that this is the midpoint and no candle is closing below the mean threshold of the other block. Do we get that? No candle is closing below the mean threshold of the other block. So seeing that, what do I want to do now? Since we are looking at today's, we want to look at what yesterday's price action to guide us to close. And if we look at even yesterday's price action, which was on Monday, we see that also price closed with a hammer. Remember, I taught you just two patterns for a purpose because this is what I consider, right? I taught you engulfing and hammers, right? In candlestick patterns. So if you see price close as a hammer, telling you that what price is rejecting off this mean threshold of this other block. Now, and bear it in mind that higher time frame, that is daily time frame institutional reference point, are strong points that will push price. The algos will always react off this, right? Like the name implies, it's an order block. Institutions have placed orders. They have placed orders in the order book that price will have to pick and run from that place. So there will be a reaction. That's why you see immediately price started getting into this order block, started giving reactions even before getting to the mean threshold. But you see that all the candles are not closing below this mean threshold. Once any candle closes below this mean threshold, it gives me an idea that this order block is about to be violated. Price is going to go deeper below the order block. But for now, it has not closed. So still, I'm still going with the bias that I'm still bullish on the bias, right? So now the next thing I would do, I always do this by hand. I do this by hand. Why? Because I'm not trying to get anybody to program any indicator to do this for me. I do it by hand because why? It keeps me disciplined. Every time I'm doing it, by the time I'm going through all this time frame, I'm looking at the charts. I don't just, if I have a indicator doing it for me, sometimes it will not help me get the story. So I must come on all the time frame to do this, right? I'll use the zoom tool because I want to get exactly that line, because I want to mark the exactly on top of that line, right? I want to put it exactly, it has to be close exactly on top of that line because I want to get my dealing range, right? I want to get my premium discount range, right? So I do this, right? So irrespective of what has happened, because I'm a day trader, I cannot just be waiting that, okay, because price has come to a daily order block, then I want to buy. No, I don't have that capital. Maybe probably in future when I start trading $2 million or $10 million capital, I can, maybe for want of time, I can just be executing off these zones and putting stop loss below. But for now, I even doubt I will do that in future because I'm wasting that move by doing that when I can go into a lower time frame and get more risk reward ratio. So it's better to go to a lower time frame, right? So I mark my range. I mark the range and I want to see the discount and the premium. So after marking the range, I go to at least 1 hour or 3 hours, right? So now this is where my higher time frame, the first rule, let's bring it close so you see what we're talking about, right? So I've done phase one. I've checked the first rule, right? Sorry. I've checked the first rule, order flow and candle closures on daily, right? We are on the second rule, discount and premium of range. This is the second, we're on number 2 now. discount and premium of range. That's I'm marking the range. That's my last day's range. My last day's high, previous day's high, and previous day's low is my daily range. That's my discount and premium range for the day. So I will go to the 1 hour or the 3 hours. Let me go to the 1 hour, the 3 hours to give me a direction so I can. Oh, the network is quite slow. Okay, no problem. Right here. So this is it, right? So this is my range. So I'm looking at my range now to see the market structure formed, right? Let me drag. Where is the rule? Oh God, I have to go and drag it. Sorry, I have to keep it very close. Did someone kind of like jot it down so I can tell us what is rule 3? Did anybody jot it down? Let me know if you like people that are taking notes.
Yes, I did.
Okay,
We'll treat higher
rule
time
3.
frame PDRA in discounts for premium.
Okay, higher time frame PDRA in discount or premiums, right? So I use my Fibonacci. Last class, I taught you how to create your levels on the Fibonacci. So I take from down, it doesn't matter, down to up, right? Remember, I taught you guys this first class, right? So this is premium, this is discount, right? So now I'm looking for a higher time frame PDRA in discount or in premium. Now this is where that rule applies. Now we have to play price for when I come into the charts, because I trade London session mostly now. I used to trade both sessions, but right now, so this is Tuesday, right? So I always like to mark this. Sorry, you have to do this. Don't depend on indicator at this level. Do this now because it's in grind discipline. It's making you understand the chart more, right? So I always do this every day. Every day I do this. So today is Tuesday, right? So at all this time I'm sleeping, so I'm not doing anything. So I have to play price to see when. Okay. Sorry, it's going to be a little close. The network is quite slow. I don't know if I should switch. Okay, I want to, when we come into Tuesday, I normally come into my chart around 1, which is 6 a.m. Okay. Let's see. Okay. So, sorry, the network is slow, but I wish. So that's this around this day. This is Tuesday. Okay, we are not yet in 12. Let's go to the next candle. Oh, okay, good. So this candle exactly, this is the 1 a.m. candle. Can you see the time there? Can we all see the time there? This is 1 a.m. New York time, which is our 6 a.m. Nigerian time, right? Are you guys with me? Am I too fast? Am I too fast?
Yeah, okay, well, with you.
Perfect.
Okay. This is my 1 a.m. So this is the time I come to the chart because I'm looking for entries. My entry time, please note these times. They are very important. Most times I will not enter. Okay, it's depend. I will not enter any trade until 2 a.m., which is 7 a.m. These are what I think ICT calls kill zones, but I'll not enter from till 2 a.m. This is what I'm looking for because there's a liquidity that is created at 2 a.m. That liquidity is called Asian launch liquidity. I talked about it in our last class, right? So Asian launch liquidity is the liquidity that's the highest high between 11 p.m. New York time to 2 a.m. the next day New York time, right? So someone asking a question?
Yeah, James, so sorry. The 1 a.m. and 2 a.m. you just mentioned, is that New York time?
That's New York time. So you convert.
All right, cool.
Because my strategy basically is based off New York, so I understand it better. So I didn't bother convert. I don't convert to Nigerian time. I just use New York time on my chart every time. So if you prefer Nigerian time, you can convert it, right? So I think it's -4 hours. See it under here in Trading View. So it's -4 hours of UTC. I think we're in UTC, so just -4 hours from the current time in New York. Is it -4 hours, +4 hours? I don't know, but let's sort it out. But I know it's 1 a.m., right? So so currently at 1 a.m., that this is what was going to guide my bias at this particular time, right? This is where number 3 comes. At 1 a.m., where is price? Price is in discount, right? Guys, are you with me?
Yeah.
Price is in discount, and that, what does it tell me? It tells me that I'm looking to buy because I want to buy when price is discounted. And from our higher time frame, from our rule 1 and rule 2, our bias was more inclined to what? To buy, right? Are you guys following? So this tells me that I'm going to buy for today because price right now at 1 a.m. price is in what? Is in discount, right? So now I have to look for a higher time frame PD array, higher time frame institutional reference point, right? Read that rule 2 again, so I'm sure I'm following it. What's the rule 3? Rule 3.
Higher time frame PD array in discount of premium in
Okay.
brackets. For example.
Okay. So I'm looking for breaker block of fair value gaps that are in discount. In this case, we're looking for them in discount because we are looking to buy, right? So I'm looking for that anyway because I focus basically on that, right? So on the 1 hour time frame, like I consider my higher time frame from 15 minutes up to the 4 hour is my higher time frame. So I'll be looking for this. Since I didn't see any fair value gap in that discount. Like, can we see my chart clearly? I didn't see any fair value gap in that. I'm seeing an order block, but I don't trade order blocks. So I'll stick. I always stick to what I trade. I will go down. Not every chart. Most of you will not get 45 minutes chart on Trading View, but that's why you need to register on this traders view. It's easier and it's cheaper for you, even if you have to pay. Sorry, the network, I don't know if I switch to my network, the other network quickly, it will work, but this network is quite slow. Okay, right? So I'm on the 45 minutes chart now. Voila. What can we see there? Remember what I taught you about? That's why I went through the diagram, right? Let me mark something for you so you see what I'm talking about, right? Oh dear, the network. Guys, please just give me some seconds. Let me switch my data. This is just resetting and it's getting too slow. Might just delay our class. Okay, let's see. It has gone. So, right, this is it. Guys, what is this?
Fair value gap.
That's a fair value gap, right? Okay. But I don't, number one thing I look at, I don't even look, that's one confluence, right? But I will not even be iffy about this thing. I'll still go down because what I'm always wanting to look for, I'm looking for inversion fair value gap, right? Because when price violates a fair value gap, that zone to me becomes a good, like a building block, right? So I'll go to the 30 minutes time frame. I stop at 15 minutes. I want to find them, right? At 30 minutes is still, you see, 30 minutes is even a wider fair value gap, but it's still the same thing. So I go down, I see. Now, can we see, we have another thing I look at, breaker block. There's a breaker block here. But let me tell you why I will not consider this a breaker block here. Do we see that? Let me take this thing off so we see it's lighter. This thing is slow. Let me switch network. I think if I do it fast, it might not affect the network. Guys, can you hear me?
Yes, sir.
Okay, so I've switched to the network. Okay. Yeah, so you see it's faster now. So you see, so can you see that's like a breaker block, right? Because that's like an order block. It took out this level, it took out liquidity here and here, right? Then price violated it. That becomes a breaker. But I'm just opening your eyes so you look at, you could have traded off this breaker block, but I prefer using FVG or IFEG, right? So I'll go to the 15-minute time. Oh yeah, this network is clearer. Okay. Now in this case, Okay, I didn't get my primary. So if we go here, we can also see that on the 15 minutes time frame, it also refines the breaker for us. It's a refined breaker there. So can you see two confluences? So this is rule 3, finding higher time frame bias. So I didn't find IFEG, but I find fair value gap. So I will go with it. So that's why I say I trade IFEG or fair value gap, right? So let's mark that. Let's mark the fair value gap on the 15 minutes time frame here. Let's mark it with yellow, right? So from here to here, let's mark it from here. Now, I'll expect someone to have a question. If you don't have a question, bro, that means you understand. Okay, so let's mark from here to here, right? Now, remember what I told you guys about the midpoint, right? So the midpoint for fair value gap is called CE, consequent encroachment. It's called consequent encroachment. It's called CE, right? Consequent encroachment. Don't ask me why it's called that. Encroach. I hope I'm right in the spelling, right? But short from CE, right? So I always want on my higher time frame for price to come to consequent encroachment or consequent encroachment of the fair value gap or the inverted fair value gap. In this case, I don't go lower than 15 minutes. So at the 15 minutes, it's still the fair value gap. So I'll work with that. So what next do? I wait. Once I've gotten my zone right now, I'm going to the lower time frame. What's my lower time frame? What's the rule for?
Market structure, 15 minutes to 4 hours.
Okay, market structure on 15 minutes, right? Because I found my PD array on 15 minutes. Now, I want to look at market structure on the 15 minutes, right? To validate my trade. Now, if we look at this, now, can we see that this breaker that took out the low, took out this point, this particular breaker that took out this point here, right? This was the last point, right? When it took out point, price went and closed above this point here. Okay, this went on this point. Okay, let's follow structure and see. Okay, this low, not this point. It didn't take out this point. Let's follow structure. Okay, truly, this was it. This was the real higher high. Is that called a higher high? Yes, or lower high? Yes, the lower high that took us low to take out this point here, right? So now we are looking, you see price has closed above it. That's why I say I look at market structure too to also guide me previously. Price closed above it with a candle. That tells us that that is a break of market structure, right? So price has broke to the upside. So this also validates my point that I'm going bullish, irrespective of what you see, all this bearish move down here, right? For price to really be bearish, price must come down and close below this level. Remember your class on market structure, right? Because this is the impulse that took us to up to break this structure up here, right? Are you guys with me?
Yeah.
Majorly, this is the impulse, right? But now, if you are looking at the concept of inducement, we can call this, you see that, okay, this now becomes our higher low. This now becomes where we are not marking all these points, but this now becomes our higher high that took us to the higher low, higher high, higher low, right? Inside the inside structure, this is inside structure, microstructure. In this structure, the main structure here, this is the main structure point, but this is the inside structure in this inside structure point. But I'm not considering the inside structure because I'm looking at the main structure. Because we have taken out the lower high that took us down to this low, we are bullish now. So I'm looking for any of this main outside structure to be violated before I know that I'm bearish. So this also aligns with my bias that I'm going bullish. Gives me confidence also that I can take a trade off of this fair value gap, right? So I go to the 1 minute time frame. So what's the next rule?
Lower time frame break of structure with IFG or paper block theory.
Okay. Okay. Now, this is where we have to pay attention, right? Remember I told us about the Asian liquidity, right? So this is the lowest low from that time, right? So since I'm looking to buy, this is liquidity. These are people that have gotten in before the opening, the 2 a.m. time, Q zone time, where I look. So I'm looking for, and you see also our midpoint has not been got into. Now you see all these things are liquidity and taking people are people that are rushing in to enter. Some people think, okay, we have come to this fair value gap, they buy here, they might put their stop loss under net here. It came down in. Once price has not come down to this midpoint, every other thing is still liquidity. And this is also a confluence. When you see that the Asian launch liquidity is still above your consequent encroachment. This is not to say that sometimes price will not just shoot up. That's why most times I prefer to miss the trade. It's not every trade. You don't chase price. You just stick to what the strategy and what you are looking at in the marketplace, right? So I will be waiting. So if we play price, okay, this is at 2, right? At 2 price imposed. Let's see if it's stuck to our see. I'm still waiting. Can you see what happened? Okay. Can you see how this was just trap for liquidity for people? People that saw this move, some people consider this place break of structure. This particular point break of structure and start going to buy. You see that all of them will be liquidity because price has not come down to this consequent encroachment of this thing. So let's play price and see. So what's the next one? I'm waiting for break of market structure after the liquidity has been run, right? On this time. So note that. Then I'm waiting for break of market structure with the institutional reference point to trade. So now let's pause there. Let's pause here and let me explain to you so you understand. Now for my structural range now, right? This is the point that took out liquidity down here. So for price to be bullish, price must break this point. So this will be a point where it will be my break of market structure. Did we get? Guys, can you hear me? Is my network great? Please pay attention. So this will be my break of market structure. Now when I'm at a POI, this is also called a POI. This is my fair value gap I mark. This is also what is called POI, or point of interest. This is the point of interest that I'm looking to take my trade off. So it's a point of interest and it aligns with my strategy, which is a higher time frame point of interest. I say from 15 minutes upward, that's my higher time frame because I enter off the 1 minute. Sometimes I go off the 30 seconds, right? But for you guys that are beginners, stick with your 1 minute for now. 1 minute is even a whole lot for you to understand. For now, you have to practice a lot, right? So this is the point that took us to this low. So I'm looking for market to break above this point for me to buy. So I'm still waiting, right? I've also checked one confluence for me, which was what? A grab of Asian launch liquidity. So my confluences are aligning with my buyers from the higher time frame. So I'm more confident to take this trade now, right? So I'm waiting to see. Let's see what price does. So I'm still watching. I'm not FOMOing. I'm not doing FOMO. I'm not rushing to enter thinking I'm going to miss the price. I'm still waiting for price. Why? Because I want to see a break of market structure that will give us an institutional reference point, which is my IFEG or my breaker block. But I first consider IFEG first. Let's go. Let's go. So you see, I'm not foaming, I'm not rushing to enter any trade. I'm seeing price go, but I know what I'm looking for. It's a rule. It's rule based. Good. Now I've got to my break of market structure. Pay attention. What's the next rule?
Entry at inverse fair value gap or breaker block with stop loss above or below.
Okay, now you can see now. Now I'm looking for, my eyes are like a magnet. I'm looking for fair value gaps, right? So let me mark it for you. I'm looking for inverted fair value gap. Fair value gaps that have been violated. This is it. Can we see that? Oh, sorry. So I'll mark it over time, right? This is my sweet spot. This is my number one precedence, right? I only use breaker block when I don't see any fair value gap, inverted fair value gap. So I always like to annotate, right? So that's my sweet point. That's one confluence. This is not in the rule, but add it. Take notes now. Take notes. Number two confluence. I also want to also buy in discount of the 1 minute range. So this is my 1 minute dealing range. From this high to this high is my 1 minute dealing. I want to also buy in that dealing range, right? So I will mark my Fibonacci also to this point. I'll keep marking it to the highest point, from this low to the highest point, and be play till, because I want to buy when price is at equilibrium. Can you see that red line? You see that for now the red line aligns with my inverted fair value gap. Let's play price and see if we need to move, right? Price still went up. So this is what I'll do. When price goes up, I'll go to the highest point and mark my this thing. Let me kind of dull this one a bit so it will so you see the line. So this red line, this is the midpoint, this is the equilibrium point. Discount is down out here. So most times price will take off from equilibrium point or in discount. So if you look at this price again, you see that there's another confluence again, multiple confluence. There's another fair value gap, not inverted, another fair value gap that is within multiple fair value gap within this range, but I'm not going to mark them because can you see that? Can you guys see that? There are two fair value gaps, 1, 2. But this second one is the one that is in discount. Can you guys see that? Hello, guys. Flow with me.
Yes,
Okay. Okay. So I mark this and I'm waiting patiently because I want price to come there, right? So off the hook, I always want to take my execution. I take market orders, but for you starting as beginner, please to stick to understand the strategy. This is my sweet spot. Put your entry at the start of this inverted fair value gap and your stop loss. Now write this down as a rule. For GU, remember I told you choose one pair, but I'm teaching you, I advise you to use GU. For GU, make sure your stop loss is not below 5 pips. Why do I say below 5 pips? Because most times you are still learning the strategy. By the time you develop experience, you can now reduce it. You can make it smaller. But for now, make it below 5 pips. Now you see 5 pips still aligns with what we are looking for because we are looking to be way below the candle 2 of our inverted. You see, this is candle 1, candle 2, candle 3 that created that fair value gap that was violated and became the inverted fair value gap. So we want to be below candle 2. You see, this could have been a 2 pips stop loss, but it's too small. Price might likely whip liquidity underneath, so you want to give gap. Now the safest place is to be between 5 pips or to be below this low, this particular low, right? You see 5 pips is below this particular candle. You want to be safe below. This is your safest place, and I'll advise you by our next class you will understand why I say start with 1:3. Start with 1:3, and for beginners, if you are just starting, start with risking 0.5% of your account and target 0.5% to target 1.5, right? So that's 1:3. But you understand this clearer in our risk management class, right? So this will be my safe entry. Let's watch and see what price does. And you are done for the day, right? Can you guys see? What time is it now? That's why I tell you, trading is not time. What time is it? It's 3:32. So how many hours have you spent on the chart? You have spent roughly 2 hours, 30 minutes on the chart. And most times, once you enter, you cannot even, because you cannot control the trade once you enter. So it's even safe for you to just leave the charts, right? I always teach my students, once you are targeting 1:3, you are targeting 3, risking 1, targeting 3, you don't need to stay. There's nothing you can do to the trade once you have entered the trade. So leave it. If it hits stop loss, it's a loss for the day. You go to the next day. Do you get? This is simply what I call the god of indices. This is from higher time frame to entry. This is my entry. Now, if you look at this particular entry, now for me, because I've built experience, I target, my minimum is 1:5. That's my minimum target. So I either get 1:5 out of the market, or I get break even, or I get stop loss. Those are three things that can happen. And if you play this price, you will see that most likely for today, I didn't trade GU today, but most likely for today, it reached for 1:5, even exceeded. Can you see? It exceeded 1:5. Are you guys with me?
Yeah, bro.
Yes.
So this is how I view the market from higher time frame to, can you see that my whole strategy is, I've explained it in less than an hour for you to understand. This is just the strategy. This is what I do every day. I rinse and I repeat. Every day I'm repeating the same thing every day. Those rules I've written down for you. Now, this is where your work, you have to roll up your sleeves and work, right? You have to go to the charts and start looking at this thing every day. Every day. Before want of time, I'm not going to be teaching you back testing, but this is back testing I just taught you with this software, right? So you can use Traders View. I dropped a link of this Traders View on the Telegram channel. So for most of us, if you register, just go and look for it. You see the link I dropped. Register. It gives you, it's free of charge. Trading View, you have to pay money to get this bar replay. This is in a nutshell. I've taught you my strategy and I've taught you how to backtest. This is how to backtest. Also, so this is what you need to do for countless numbers of days. You repeat it over again till you master the strategy and you start doing it every day. You rinse and repeat. Profitable trading is boring trading. It's boring. You just have to wait. It's boring. Can you see? There's nothing exciting about what I just taught you. It's very boring because I'm repeating the same thing every day, all over and over again. Right? So we see now, let me just show you something. We see if we decided to stick to that to just being below, you see, in this case too, if that been, you wouldn't have been taken out. But maybe if you're trading a brokerage account, or depending on this thing, spread will take you out. And that's why I always advise for starters, keep it at least 5 pips, right? But if I was entering this trade, I would have been safe to be around 4.4, but just keep it, for starters, keep it at least 5 pips. You see, with your 5 pips, you can still get your 1:3. Even with 5 pips, you still got your 1:5. But please, this is where discipline comes to place. I'm repeating it again. For starter, stick to 1:3. In our next class, when I explain risk management, you understand why 1:3 is very powerful. Someone I know in the trading industry say 1:3 keeps SAPA away. 1:3 keeps poverty at bay. 1:3 keeps you in financial freedom in forex market. You don't need to chase. Me, I'm doing this because over time I've gained experience. So that's why this strategy is so foolproof. Because why? I can take losses. I can take 3 consecutive losses for 3 days. My next win will keep me in 2% profit. And I've tested this strategy over and over again. It's highly impossible. I'm saying highly impossible. I've not experienced it yet. For the past 1 year that I've been trading this strategy, I've not experienced it where I get 8 straight losses in the market, where I'll take 1 stop loss, I'll come the next day, I'll take 8 losses in the market. I've never, for the past 1 year. based on this strategy. So if you stick to this, it works. Stick to your 1:3. And for beginners, stick to 1 trade a day. 1 pair. Now this is the rule. You can write this down. 1 trade, 1 pair, 1 session,